Happy Friday, Eric Bibel with the Bible team at Neil Home Loans. As we prepare for this long weekend, we can finally take a breath and breathe a sigh of relief as mortgage rates have pulled back from their recent highs of 7.37 to this morning's start of 7.07. Yes, not in the sixes, not in the fives, as we would like, but any move down is absolutely a welcome reprieve. And this question becomes, what has prompted this sharp reversal and quick pivot? And it's centered around labor. Now, as we know, this cycle began rates rising, centered on the concept of runaway inflation. And don't get me wrong, inflation is still a persistent concern. And the Fed has mentioned this time and time again, where yes, inflation has come down and come down sharply. The focus is now shift on maintaining a level of stability inflation, and with employment still showing signs of a robust labor market, the Fed is now concerned that inflation will not go away until we start to see a weakening labor market. Well, that weakness has appeared, and it's appeared this week. And it started earlier with a report called JOLTS, Job Opening and Labor Turnovers. And this measures new and open jobs, essentially the strength of the labor market. And there, markets were anticipating a pretty sharp number, over 9 million, and it came in 600 plus thousand less. So that was sign number one. Then we move forward into ADP, which again, we know ADP is a private company. It measured private payrolls. There we saw a miss as well, coupled with GDP revisions for quarter two. Markets were expecting a 2.4% read showing expansion. That number came in at 2.1%. And this coupled with the signs that the labor market was contracting or starting to contract, rates really continued their run forward, moving mortgage interest rates down. And we fast forward to this morning. The BLS Jobs Report, really the center focal piece for the Federal Reserve's and their decision-making process around monetary policy, really the report they look at when considering what they do going forward, where the non-farm payroll, so new job creations, was a miss. It was a miss against our favor. We saw 187,000 new jobs created when the market was bracing for around 177. The surprise came in both wages and unemployment. Unemployment spiked from 3.5% to 3.8%, a very sharp uptick inside a small window of time. Additionally, we saw wages pull back, which those two components really continue to now beat the narrative that the labor market is in fact cooling. And as we saw Jerome Powell speak last week, centered around where, yes, they've seen positive signs on inflation abating, the labor market is still robust. And until we see signs that the labor market is pulling back, we don't know what we're going to do going forward. So today we really got the nail in the coffin, if you want to call it, that the labor market is not as strong as we believed. And here the question becomes, what will the Fed do with this information? Now, again, all guesses to this point, as we know, have been wrong. But given the outline that the Federal Reserve provided over the preceding weeks, there's a strong argument to be made that in the September 20th meeting, we could see a pause on further rate hikes. So again, all eyes will be on that information in the coming weeks. And again, we will be reporting as that information comes forward, but definitely a victory this week. Mortgage rates are absolutely loving this news. And that brings me to my final point, where absolutely transactions are still taking place. We know this. We've seen home prices continue to accelerate. We continue to see multiple offers on properties. And if assuming the property is priced correctly, the home is selling very quick. Demand is still persistent. There are a plethora of buyers still wanting to engage in real estate activities. We just have to know where to look for them and the messaging to convey to our clients. One item that we are seeing a tremendous amount of success, really as of recent, with rates breaking into the mid-7 range, is this concept around the permanent buy down. And yes, there is that tipping point for clients. Rates in the sevens, we start to see some trepidation in moving forward. And I've provided an example that we just put together for a client that was making an offer on a property. The seller was entertaining a significant price reduction, 1.5 million to 1.45 million. Client was eager to see that come to fruition. And with that, though, as we know, a price reduction reduces the net proceeds to the seller. So it really became a win-lose situation. So what we proposed was this concept around a permanent buy down, where we allocated funds from the seller to buy the interest rate down for the duration of the mortgage. And the concept I provided below was basically what it would be payment wise with the $50,000 price reduction, and then what it would look like with, instead of taking a $50,000 price reduction, let's credit the buyer $25,000 and apply it towards the interest rate. The numbers are staggering. The client was able to save $793 a month, which was an equivalent to if the purchase price was $147,000 less. Client won in that they saved close to $800 a month, and the seller preserved $25,000 to their net proceeds. So a victory across all channels. If you need help conveying this concept, or if your client is potentially entertaining a significant price cut, we would love the opportunity to speak with you, as we've got some amazing tools to help paint a different picture. As always, we're here to support you. If you need help conveying any of these messages, questions, don't hesitate to reach out. Make it a great day and an even greater long weekend. Thank you.